World shares.
The remarkable success of the Warren Buffett way is reasonable proof that our work was helpful. With over 600,000 copies in print, including 12 foreign language translations, I am confident the book has endured sufficient scrutiny by professional and individual investors, as well as academicians and business owners. To date, feedback from readers and the media has been overwhelmingly positive. The book appears to have genuinely helped people invest more intelligently. As I have said on many occasions, the success of the Warren Buffett way is first and foremost a testament to Warren Buffett. His wit and integrity have charmed millions of people worldwide, and his intellect and track record have for years mesmerized the professional investment community, me included. It is an unparalleled combination that makes Warren Buffett the single most popular role model in investing today. This new book, The Warren Buffett Portfolio, is meant to be a companion to The Warren Buffett Way, not a sequel to it. I have come to realize that in the original work I unwittingly passed lightly over two fundamentally important areas, structure and cognition, or in simpler terms, portfolio management and intellectual fortitude. I now realize more powerfully than ever that achieving above-average returns is not merely a matter of which stocks you pick, but also how you structure your portfolio. Also, that to successfully navigate a focused portfolio, you need to acquire a higher-level understanding of price volatility and its effect on individual behavior. And in addition, you need a certain kind of personal temperament. All these ideas come together in the Warren Buffett Portfolio. You might think of the two companion books this way. The Warren Buffett Way gives you the necessary tools to help you pick common stocks, and the Warren Buffett Portfolio shows you how to organize them into a focused portfolio and provides the intellectual framework for managing it. Since writing The Warren Buffett Way, I have spent all my time investing according to the tenets outlined in that book. Indeed, the Legg Mason Focus Trust, the mutual fund which I manage, is a laboratory example of the book's recommendation. To date, I am happy to report the results have been very satisfactory. Over the last 4 years, in addition to gaining experience managing a focused portfolio, I have had the opportunity to learn several more valuable lessons, which I describe here in the Warren Buffett Portfolio. Buffett believes that it is very important to have a fundamental grasp of mathematics and probabilities. He also believes it is very important that investors understand the psychology of the market. He also warns us against the dangers of relying on market forecasting. However, his tutelage has been limited in each of these areas. Whereas we have an ample body of work to analyze how he picks stocks, the number of words Buffett has publicly used to describe probabilities, psychology, and forecasting are comparatively few. This does not diminish the importance of the lessons. It simply means I have been forced to fill in the blank spaces with my own interpretations and the interpretations of others. In this pursuit, I have relied on the mathematician Ed Thorpe, Ph.D., to help me better understand probabilities, Charlie Munger to help me appreciate the psychology of misjudgment, and Bill Miller to educate me about the science of complex adaptive systems. A few general comments about the structure of the book, if I may. Imagine two large, not quite symmetrical segments, bracketed by an introductory chapter and a conclusion. The first chapter previews, in summary fashion, the concept of focus investing and its main elements. The next 4 chapters constitute the first large segment. Taken together, they present both the academic and statistical rationale for focus investing and explore the lessons to be learned from the experiences of well-known focus investors. We are interested not only in the intellectual framework behind focus investing, but in the behavior of focus portfolios in general. Unfortunately, up till now, the historical database of focus portfolios has contained too few observations to draw any statistically meaningful conclusions. An exciting new body of research has the potential to change that. For the past 2 years, Joan Lamb-Tennant, Ph.D., and I have conducted a research study on the theory and process of focus investing for the Research Institute for Chartered Financial Analysts. In the study, we took an in-depth look at 3,000 focus portfolios over different time periods and then compared the behavior of these portfolios to the sort of broadly diversified portfolios that today dominate mutual funds and institutional accounts. The results are formally presented in an academic monograph titled Focus Investing, an optimal portfolio strategy alternative to active versus passive management. And what we discovered is summarized in non-academic language in Chapter 4. The next 3 chapters make up the second large segment of the book. Here we turn our attention to the other fields of study, mathematics, psychology, and the new science of complexity. This is where you will find the new ideas that I have learned from Ed Thorpe, Charlie Munger, and Bill Miller. Some people may think it's strange that we are venturing into apparently unrelated areas. But I believe that without the understanding gained from these other disciplines, any attempt at focus investing will stumble. Finally, Chapter 9 gives consolidated information about the characteristics of focus investors, along with clear guidance so that you can easily initiate a focus investment strategy for your own portfolio. Robert G. Hagstrom, Wayne, Pennsylvania. Chapter 1. Focus Investing. Robert, we just focused on a few outstanding companies. We're focus investors. Warren Buffett. I remember that conversation with Warren Buffett as if it happened yesterday. It was for me a defining moment for 2 reasons. First, it moved my thinking in a totally new direction. And second, it gave a name to an approach to portfolio management that I instinctively felt made wonderful sense, but that our industry had long overlooked. That approach is what we now call focus investing, and it is the exact opposite of what most people imagine that experienced investors do. Hollywood has given us a visual cliché of what a money manager looks like, talking into 2 phones at once, frantically taking notes while trying to keep an eye on jittery computer screens that blink and blip at him from all directions, tearing at his hair whenever one of those computer blinks shows a minuscule drop in stock price. Warren Buffett, the quintessential focus investor, is about as far from that kind of frenzy as anything imaginable. The man whom many consider the world's greatest investor is usually described with words like soft-spoken, down-to-earth, and grandfatherly. He moves with the calm that comes of great confidence, yet his accomplishments and his performance record are legendary. It is no accident that so many pay such close attention to what he does. If Buffett characterizes his approach as focus investing, we would be wise to learn what that means and how it is done. Focus investing is a remarkably simple idea, and yet, like most simple ideas, it rests on a complex foundation of interlocking concepts. If we hold the idea up to the light and look closely at all its facets, below the bright clarity of the surface we will find depth, substance, and solid thinking. In this audio, we will look more closely at these underlying concepts one at a time. Here, I hope merely to introduce you to the core notion of focus investing. The goal of this overview chapter is also, broadly speaking, the goal of the book, to give you a new way of thinking about investment decisions and managing investment portfolios. Fair warning, it is in all likelihood the opposite of what you have always been told about investing in the stock market. It is as far from the usual way of thinking about stocks as Warren Buffett is from that Hollywood cliché. The essence of focus investing can be stated quite simply. Choose a few stocks that are likely to produce above-average returns over the long haul, concentrate the bulk of your investments in those stocks, and have the fortitude to hold steady during any short-term market gyrations. Easier said than done, you may be thinking. No doubt that summary statement immediately raises all sorts of questions in your mind. How do I know which are those above-average stocks? How many is a few? What do you mean by concentrate? How long must I hold? And most of all, why should I do this? The full answers to those questions are found in the subsequent chapters. For now, let us construct an overview of the focus process, beginning with the very sensible question of why you should bother. Portfolio management today, a choice of 2. The current state of portfolio management appears to be locked into a tug-of-war between two competing strategies: active portfolio management and index investing. Active portfolio managers are constantly at work buying and selling a great number of common stocks. Their job is to try to keep their clients satisfied, and that means consistently outperforming the market so that on any given day, should a client apply the obvious measuring stick, how is my portfolio doing compared to the market overall, the answer is positive, and the client leaves her money in the fund. To keep on top, active managers try to predict what will happen with stocks in the coming 6 months and continually churn the portfolio, hoping to take advantage of their predictions. On average, common stock mutual funds own more than 100 stocks and generate 80% turnover ratios. Index investing, on the other hand, is a buy-and-hold passive approach. It involves assembling and then holding a broadly diversified portfolio of common stocks deliberately designed to mimic the behavior of a specific benchmark index, such as the Standard & Poor's 500. Compared to active management, index investing is somewhat new and far less common. Ever since the 1980s, when index funds fully came into their own as a legitimate alternative strategy, proponents of both approaches have waged combat to determine which one will ultimately yield the higher investment return. Active portfolio managers argue that, by virtue of their superior stock-picking skills, they can do better than any index. Index strategists, for their part, have recent history on their side. In a study that tracked results in a 20-year period from 1977 through 1997, the percentage number of equity mutual funds that have been able to beat the Standard & Poor's 500 index dropped dramatically, from 50% in the early years to barely 25% in the last 4 years. Since 1997, the news is even worse. As of November 1998, 90% of actively managed funds were underperforming the market, averaging 14% lower than the Standard & Poor's 500, which means that only 10% were doing better. Active portfolio management, as commonly practiced today, stands a very small chance of outperforming the index. Frenetically buying and selling hundreds of stocks each year, institutional money managers have, in a sense, become the market. Their basic theory is, buy today whatever we predict can be sold soon at a profit, regardless of what it is. The fatal flaw in that logic is that given the complex nature of the financial universe, predictions are impossible. Further complicating this shaky theoretical foundation is the effect of the inherent costs that go with this high level of activity, costs that diminish the net returns to investors. When we factor in these costs, it becomes apparent that the active money management business has created its own downfall. Indexing, because it does not trigger equivalent expenses, is better than actively managed portfolios in many respects. But even the best index fund, operating at its peak, will only net you exactly the returns of the overall market. Index investors can do no worse than the market, and also no better. From the investor's point of view, the underlying attraction of both strategies is the same: to minimize risk through diversification. By holding a large number of stocks representing many industries and many sectors of the market, investors hope to build in a warm blanket of protection against the horrific loss that could occur if they had all their money in one arena that suffered some disaster. In a normal period, so the thinking goes, some stocks in a diversified fund will go down, others will go up, and let's keep our fingers crossed that the latter will compensate for the former. Our chances are better, active managers believe, the more stocks the portfolio contains. 10 is better than 1, and 100 is better than 10. An index fund, by definition, affords this kind of diversification if the index it mirrors is also diversified, as they usually are. So does the traditional stock mutual fund, with upwards of 100 stocks constantly in motion. We have all heard this mantra of diversification for so long, we have become intellectually numb to its inevitable consequence: mediocre results. While it is true that both active and index funds offer diversification, in general, neither strategy will give you exceptional returns. The question intelligent investors must ask themselves is this: am I satisfied with average? Can I do better? A new choice. What does Warren Buffett say about this ongoing debate between index versus active strategy? Given these two particular choices, he would unhesitatingly pick indexing. This is especially true for investors with a very low tolerance for risk, and for people who know very little about the economics of a business, but still want to participate in the long-term benefits of investing in common stocks. By periodically investing in an index fund, he says in inimitable Buffett style, the know-nothing investor can actually outperform most investment professionals. Buffett, however, would be quick to point out that there is a third alternative, a very different kind of active portfolio strategy that significantly increases the odds of beating the index. That alternative is focus investing. Focus investing, the big picture. Find outstanding companies. Over the years, Warren Buffett has developed a way of choosing the companies he finds worthy places to put his money, and it rests on a notion of great common sense. If the company itself is doing well and is managed by smart people, eventually its inherent value will be reflected in its stock price. Buffett thus devotes most of his attention not to tracking share price, but to analyzing the economics of the underlying business and assessing its management. This is not to suggest that analyzing the company, uncovering all the information that tells us its economic value, is particularly easy. It does take some work, but Buffett has often remarked that doing this homework takes no more energy than that which is expended in trying to stay on top of the market, and the results are infinitely more useful. The analytical process that Buffett uses involves checking each opportunity against a set of investment tenets or fundamental principles. These tenets, presented in depth in The Warren Buffett Way, can be thought of as a kind of tool belt. Each individual tenet is one analytical tool, and in the aggregate, they provide a method for isolating the companies with the best chance for high economic returns. The Warren Buffett tenets, if followed closely, lead you inevitably to good companies that make sense for a focused portfolio. That is because you will have chosen companies with a long history of superior performance and a stable management, and that stability means that they have a high probability of performing in the future as they have in the past. And that is the heart of focus investing. Concentrating your investments in companies with the highest probability of above-average performance. Probability theory, which comes to us from the field of mathematics, is one of the underlying concepts that make up the rationale for focus investing. In Chapter 6, you will learn more about probability theory and how it applies to investing. For the moment, try the mental exercise of thinking of good companies as high-probability events. Through your analysis, you have already identified companies with a good history and therefore good prospects for the future. Now it's just a question of taking what you already know and thinking about it in a different way, in terms of probabilities. Less is more. Remember Buffett's advice to a know-nothing investor to stay with index funds? What is more interesting for our purposes is what he said next. If you are a know-something investor, able to understand business economics, and able to find 5 to 10 sensibly priced companies that possess important long-term competitive advantages, conventional diversification, broadly based active portfolios, makes no sense for you. What's wrong with conventional diversification? For one thing, it greatly increases the chances that you will buy something you don't know enough about. Know-something investors, applying the Buffett tenets, would do better to focus their attention on just a few companies, 5 to 10, Buffett suggests in this quote. Others who adhere to the focus philosophy have suggested an even smaller number, even as low as 3. For an average investor, a legitimate case can be made for 10 to 15. Thus, to the earlier question, how many is a few, the short answer is no more than 15. More critical than determining the exact number is understanding the general concept behind it. Focus investing falls apart if it is applied to a large portfolio with dozens of stocks. Warren Buffett often points to John Maynard Keynes, the British economist, as a source of his ideas. In 1934, Keynes wrote to a business associate, "It is a mistake to think one limits one's risks by spreading too much between enterprises about which one knows little and has no reason for special confidence. One's knowledge and experience are definitely limited, and there are seldom more than 2 or 3 enterprises at any given time in which I personally feel myself entitled to put full confidence. Keynes's letter may be the first piece written about focus investing. An even more profound influence was Philip Fisher, whose impact on Buffett's thinking has been duly noted. Fisher, a prominent investment counselor for nearly half a century, is the author of 2 important books, Common Stocks and Uncommon Profits, and Paths to Wealth Through Common Stocks, both of which Buffett admires greatly. Phil Fisher was known for his focus portfolios. He always said he preferred owning a small number of outstanding companies that he understood well to a large number of average ones, many of which he understood poorly. Fisher began his investment counseling business shortly after the 1929 stock market crash and remembers how important it was to produce good results. Back then, there was no room for mistakes, he remembers. I knew the more I understood about the company, the better off I would be. As a general rule, Fisher limited his portfolios to fewer than 10 companies, of which 3 or 4 often represented 75% of the total investment. It never seems to occur to investors, much less their advisors, he wrote in Common Stocks in 1958, that buying a company without having sufficient knowledge of it may be even more dangerous than having inadequate diversification. More than 40 years later, Fisher, who today is 91, has not changed his mind. Great stocks are extremely hard to find, he told me. If they weren't, then everyone would own them. I knew I wanted to own the best or none at all. Ken Fisher, the son of Phil Fisher, is also a successful money manager. He summarizes his father's philosophy this way: "My dad's investment approach is based on an unusual but insightful notion that less is more." Put big bets on high-probability events. Fisher's influence on Buffett can also be seen in another way: his belief that the only reasonable course when you encounter a strong opportunity is to make a large investment. Like all great investors, Fisher was very disciplined. In his drive to understand as much as possible about a company, he made countless field trips to visit companies he was interested in. If he liked what he saw, he did not hesitate to invest a significant amount of money in the company. Ken Fisher points out, "My dad saw what it meant to have a large position in something that paid off." Today, Warren Buffett echoes that thinking. With each investment you make, you should have the courage and the conviction to place at least 10% of your net worth in that stock. You can see why Buffett says the ideal portfolio should contain no more than 10 stocks, if each is to receive 10%. Yet focus investing is not a simple matter of finding 10 good stocks and dividing your investment pool equally among them. Even though all the stocks in a focus portfolio are high-probability events, some will inevitably be higher than others, and they should be allocated a higher proportion of the investment. Blackjack players understand this intuitively. When the odds are strongly in your favor, put down a big bet. In the eyes of many, investors and gamblers have much in common, and in fact both draw from the same science, mathematics. Along with probability theory, the field of mathematics provides another piece of the focus investing rationale, in what is known as the Kelly optimization model. The Kelly model is represented in a formula that uses probability to calculate optimization, in this case, optimal investment proportion. The Kelly model, along with the fascinating story of how it was originally derived, is presented in Chapter 6. I cannot say with certainty whether Warren Buffett had optimization theory in mind when he made his purchase of American Express stock in late 1963. But it is a clear example of the concept, not to mention an example of Buffett's boldness. During the 1950s and 1960s, Buffett served as general partner in a limited investment partnership in Omaha, Nebraska, where he still lives. The partnership was allowed to take large positions in the portfolio when profitable opportunities arose, and in 1963 one such opportunity came along. During the infamous Tino DeAngelis salad oil scandal, American Express share price dropped from $65 to $35 when it was thought the company would be held liable for millions of dollars of fraudulent warehouse receipts. Warren invested $13 million, a whopping 40% of the partnership's assets, buying close to 5% of the shares outstanding of American Express. Over the next 2 years, the share price tripled, and the Buffett partnership walked away with a $20 million profit. Be patient. Focus investing is the antithesis of a broadly diversified, high-turnover approach. Although focus investing stands the best chance among all active strategies of outperforming an index return over time, it does require investors to patiently hold their portfolio when it appears that other strategies are marching ahead. Of course, in shorter periods, we realize that changes in interest rates, inflation, or the near-term expectation for a company's earnings can affect share prices. But as the time horizon lengthens, the trend line economics of the underlying business will increasingly dominate its share price. How long is that ideal timeline? As you might imagine, there is no hard and fast rule, although Buffett would probably say that anything less than 5 years is a fool's theory. The goal is not zero turnover. That's foolish in the opposite direction, for it would prevent you from taking advantage of something better when it comes along. I suggest that as a general rule of thumb, we should be thinking of a turnover rate between 10 and 20%. A 10% turnover ratio suggests that an investor holds the stock for 10 years. A 20% ratio implies a 5-year period. Don't panic over price changes. Price volatility is a necessary byproduct of focus investing. In the traditional active portfolio, broad diversification has the effect of averaging out the inevitable shifts in the price of individual stocks. Active portfolio managers know all too well what happens when investors open their monthly statement and see, in cold black and white, a drop in the dollar value of their holdings. Even those who understand intellectually that such dips are part of the normal course of events often react completely with their emotions and fall into panic. The more diversified is the portfolio, the less the chances that any one share price change will tilt the monthly statement. It is true, then, that broad diversification smooths out the bumps along the way, and that is a source of great comfort to many. It is also true that a smooth ride is flat. When in the interests of avoiding unpleasantness you average out all the ups and downs, what you get is average results. Focus investing pursues above-average results. And as we will see in Chapter 3, there is strong evidence both in academic research and actual case histories that the pursuit is successful. There can be no doubt, however, that the ride is bumpy. Focus investors tolerate the bumpiness because they know that in the long run, the underlying economics of the companies will more than compensate for any short-term price fluctuations. Buffett is a master bump ignorer. So is his longtime friend and colleague Charlie Munger, the vice president of Berkshire Hathaway. The many fans who devour Berkshire's remarkable annual reports know that the two men support and reinforce each other, with complementary and sometimes indistinguishable ideas. Munger's attitudes and philosophy have influenced Buffett every bit as much as Buffett has influenced Munger. In the 1960s and 1970s, Munger ran an investment partnership in which, like Buffett at about the same time, he had the freedom to make big bets in the portfolio. His intellectual reasoning for his decisions then echoed the principles of focus investing. Back in the 1960s, I actually took a compound interest rate table, explained Charlie, and I made various assumptions about what kind of edge I might have in reference to the behavior of common stocks generally. Charlie worked through several scenarios, including the number of stocks he would need in the portfolio and what kind of volatility he could expect. It was a straightforward calculation. I knew from being a poker player that you have to bet heavily when you've got huge odds in your favor, Charlie said. He concluded that as long as he could handle the price volatility, owning as few as 3 stocks would be plenty. I knew I could handle the bumps psychologically, he said, because I was raised by people who believe in handling bumps. So I was an ideal person to adopt my own methodology. Maybe you also come from a long line of people who can handle bumps. But even if you were not born so lucky, you can acquire some of their traits. It is a matter of consciously deciding to change how you think and behave. Of course, acquiring new habits and thought patterns does not happen overnight, but gradually teaching yourself not to panic and act rashly in response to the vagaries of the market is certainly doable. You may find some comfort in learning more about the psychology of investing in Chapter 7. Social scientists have begun to seriously investigate the psychological aspects of the investment phenomenon. in a field called behavioral finance. You may also find it helpful to use a different measuring stick for evaluating success. If watching stock prices fall gives you heart failure, perhaps it is time to embrace another way of measuring performance, less immediately piercing, but equally valid. Even more valid, Buffett would say. That new measurement involves the concept of economic benchmarking, and it is presented in Chapter 4. Focus investing, as we said earlier, is a simple idea that draws its vigor from several interconnecting principles of logic, mathematics, and psychology. With a broad overview of those principles that have been introduced in this chapter, we can now rephrase the basic idea in a way that incorporates concrete guidelines. In summary, then, the process of focus investing involves these actions. Using the tenets of the Warren Buffett way, choose a few, 10 to 15, outstanding companies that have achieved above-average returns in the past and that you believe have a high probability of maintaining their past strong performance into the future. Allocate your investment funds proportionately, placing the biggest bets on the highest probability events. As long as things remain the same, leave the portfolio largely intact for at least 5 years, longer is better, and teach yourself to ride through the bumps of price volatility with equanimity. A latticework of models. Warren Buffett did not invent focus investing. The fundamental rationale was originally articulated more than 50 years ago by John Maynard Keynes. What Buffett has done, with stunning success, is put it into application, even before he gave it its name. The question that fascinates me is why Wall Street, noted for its unabashed willingness to copy success, has so far disregarded focus investing as a legitimate approach. In 1995, we launched Legg Mason Focus Trust, becoming only the second mutual fund to purposely own 15 stocks or less. The first was Sequoia Fund, and its history is told in Chapter 3. Focus Trust has given me the invaluable experience of managing a focus portfolio. Over the last 4 years, I have had the opportunity to interact with shareholders, consultants, analysts, other portfolio managers, as well as the financial media, and what I have learned has led me to believe that focus investors operate in a far different world than that which dominates the investment industry. The simple truth is, they think differently. Charlie Munger helped clarify for me this pattern of thinking with the very powerful metaphor of a latticework of models. In 1995, Munger delivered a lecture entitled Investment Expertise as a Subdivision of Elementary Worldly Wisdom to Professor Guilford Babcock's class at the University of Southern California School of Business. The lecture was particularly fun for Charlie because it centered around a topic that he considers especially important, namely how people achieve true understanding, or what he calls worldly wisdom. It is not a simple exercise of batting back facts and figures. Rather, he explains, wisdom is very much about how these facts align and combine. Munger believes that the only way to achieve wisdom is to be able to hang life's experiences across a broad cross-section of mental models. You've got to have models in your head, he explained, and you've got to array your experience, both vicarious and direct, on this latticework of models. The first rule to learn, says Charlie, is that you must carry multiple models in your mind. Not only do you need more than a few, but you need to embrace models from several different disciplines. To be a successful investor, explains Charlie, requires a multidiscipline approach to your thinking. Doing so will put you in a different place from most everyone else, Charlie points out, because the world is not multidiscipline. In that, he means, business professors typically don't include physics in their lectures, and physics teachers don't include biology, and biology teachers don't include mathematics, and mathematicians rarely include psychology in their coursework. According to Charlie, we must ignore these intellectual jurisdiction boundaries and include all models in our latticework design. I think it is undeniably true that the human brain must work in models, says Charlie. The trick is to have your brain work better than the other person's brain because it understands the most fundamental models, the ones that will do the most work per unit. It is clear to me that focus investing does not fit neatly within the narrowly constructed models popularized and used in our investment culture. To receive the full benefit of the focus approach, we will have to add a few more concepts, a few more models to our thinking. You will never be able to understand stock prices if you do not understand the concept of rationality. You will not be content with investing until you understand the behavior models that come from psychology. You will certainly not know how to optimize a portfolio without learning the model of statistical probabilities, and it is likely you will never appreciate the folly of predicting markets until you understand the model of complex adaptive systems. This investigation need not be overwhelming. You don't have to become a huge expert in any one of these fields, explains Charlie. All you have to do is take the really big ideas and learn them early and learn them well. The exciting part to this exercise, Charlie points out, is the insight that is possible when several models combine and begin operating in the same direction. The most detailed model that focus investors will have to learn is the model for picking stocks, and many of you are already familiar with that model from the Warren Buffett way. From here, we need to add just a few more simple models to complete our education, to understand how to assemble those stocks into a portfolio and manage that portfolio into the future for maximum results. But we are not alone. We have Warren and Charlie's wisdom to guide us, and we have their accumulated experience at Berkshire Hathaway. Typically, these two visionaries credit not themselves personally, but their organization, which they describe as a didactic enterprise teaching the right systems of thought, of which the chief lessons are that a few big ideas really work. Chapter 2. The High Priests of Modern Finance. Traditional wisdom can be long on tradition and short on wisdom. Warren Buffett. The worst financial disaster of the 20th century was the stock market crash of 1929 and the Great Depression that followed it. The second worst was the bear market and recession of 1973 to 1974. It did not begin with a single horrific day as did the 1929 crash, and its effects on American families were not so widespread nor so devastating, and so it does not hold the same place in our collective imagination. Yet, for finance professionals, the second period is almost as important, for it represents a very important watershed in the history of modern finance, and in particular, the development of modern portfolio theory. Looking back now with the clarity of hindsight, we can see the two very different schools of thought, which today still engage serious debate about investment philosophy, had their beginnings during this 2-year debacle. Two separate groups of people in the investment world searched for the best way to respond and arrived at different conclusions. Actually, rather than two groups, it's probably more accurate to say it was one man, Warren Buffett, and one group, everybody else. The bear market of 1973 to 1974 was a slow, tortuous process of unrelenting losses that lasted for 2 uninterrupted years. The broader markets declined by over 60%. Fixed income holders who owned lower coupon bonds saw their investment shrink. Interest rates and inflation soared to double digits. Oil prices skyrocketed. Mortgage rates were so high that very few could afford the purchase of a new home. It was a dark, brutal time. So severe was the financial damage that investment managers began to question their own approach. Looking for answers, most of the investment professionals gradually turned, some of them with great reluctance, to a body of academic study that had been largely ignored for 2 decades. Collectively, those academic studies have come to be called modern portfolio theory. Buffett turned in a different direction. Warren Buffett, the son of a stockbroker, began marking the board at his father's Omaha, Nebraska firm when he was 11 years old and bought his first shares of stock the same year. As a student at the University of Nebraska, the young man with a gift for numbers happened upon a book entitled The Intelligent Investor by Columbia University professor Benjamin Graham. Graham believed that the critical piece of investment information is a company's intrinsic value. The core task for investors is to accurately calculate this value and then maintain the discipline to buy stock only when the price is below it. Buffett was so attracted to this mathematical approach that he attended Columbia for graduate school so that he could study under Graham. After completing a master's degree in economics, Buffett returned home to Omaha and began working for his father, who by then owned a brokerage firm named Buffett, Falk and Company. It was 1952. The young Buffett set to work practicing Ben Graham's investment techniques. Just as Graham had taught him, Buffett would consider purchasing stocks only when they were selling well below calculated worth. In true Graham fashion, Buffett's interest really perked up when stock prices traded lower. While working with his father, Warren Buffett remained in close contact with his mentor, and in 1954 Graham invited his former student to join him in New York, working with the Graham-Newman Corporation. After 2 years, Graham retired, and Buffett returned to Nebraska. With 7 limited partners and $100 of his own money, he began the investment partnership that a few years later would make the stunning American Express deal described in Chapter 1. He was 25 years old. As general partner, Buffett had essentially free rein to invest the partnership's funds. In addition to minority holdings, such as American Express, he sometimes bought controlling interests in companies, and in 1962 began acquiring a struggling textile company called Berkshire Hathaway. In 1969, a dozen years after it was established, Buffett closed the investment partnership. He had set an ambitious original goal to outperform the Dow Jones Industrial Average by 10 points each year, and he had done far better. Not 10, but 22. Some of his original investors wanted to continue with another money manager, and Buffett asked his friend and Columbia classmate Bill Ruane to handle their money. Ruane said yes, and that was the beginning of Sequoia Fund. For his part, Buffett took his portion of the partnership profits and bought more shares of Berkshire Hathaway, eventually gaining control. Then, for the next few years, he settled down to managing the textile company. Portfolio management through diversification. In March 1952, about the time recent college graduate Warren Buffett went to work for his father's brokerage firm, there appeared in the Journal of Finance an article entitled Portfolio Selection by a University of Chicago graduate student named Harry Markowitz. It was not long, only 14 pages, and by the standards of academic journals it was unremarkable. Only 4 pages of text. The rest was consumed by graphs and mathematical equations, and only 3 citations. Yet that brief article is today credited with launching modern finance. From Markowitz's standpoint, it didn't take volumes to explain what he believed was a rather simple notion, that return and risk are inextricably linked. As an economist, he believed it was possible to quantify the relationship between the two to a statistically valid degree, and thus determine the degree of risk that would be required for various levels of return. In his paper, he presented the calculations that supported his conclusion. No investor can achieve above-average gains without assuming above-average risk. I was struck with the notion that you should be interested in risk as well as return, Markowitz later remarked. Although today this statement appears amazingly self-evident in light of what we have learned about investing, it was a revolutionary concept in the 1950s. Until that time, investors gave very little thought to managing a portfolio or to the concept of risk. Portfolios were constructed haphazardly. If a manager thought a stock was going to go up in price, it was simply added to the portfolio. No other thinking was required. That puzzled Markowitz. Surely it was foolish, he reasoned, to believe that you can generate high returns without exposing yourself to some kind of risk. To help clarify his thoughts, Markowitz devised what he called the efficient frontier. Being an economist, he explained, I drew a trade-off graph with the expected return on one axis and risk on the other axis. The efficient frontier is simply a line drawn from the bottom left to the top right. Each point on that line represents an intersection between potential reward and its corresponding level of risk. The most efficient portfolio is the one that gives the highest return for a given level of portfolio risk. An inefficient portfolio is one that exposes the investor to a level of risk without a corresponding level of return. The goal for investment managers, said Markowitz, is to match portfolios to an investor's level of risk tolerance and limit or avoid inefficient portfolios. In 1959, Markowitz published his first book, Portfolio Selection, Efficient Diversification of Investment, based on his PhD dissertation. In it he described more thoroughly his ideas about risk. I used standard deviation as a measure of risk, Markowitz explains. Variance, deviation, can be thought of as the distance from average. According to Markowitz, the greater the distance from the average, the greater the risk. We might think the riskiness of a portfolio defined by Markowitz is simply the weighted average variance of all the individual stocks in the portfolio, but this misses a crucial point. Although variance may provide a gauge to the riskiness of an individual stock, the average of two variances, or 100 variances, will tell you very little about the riskiness of a two-stock or a 100-stock portfolio. What Markowitz did was find a way to determine the riskiness of the entire portfolio. Many believe it is his greatest contribution. He called it covariance, based on the already established formula for the variance of the weighted sum. Covariance measures the direction of a group of stocks. We say that two stocks exhibit high covariance when their prices, for whatever reason, tend to move together. Conversely, low covariance describes two stocks that move in opposite directions. In Markowitz's thinking, the risk of a portfolio is not the variance of the individual stocks, but the covariance of the holdings. The more they move in the same direction, the greater is the chance that economic shifts will drive them all down at the same time. By the same token, a portfolio composed of risky stocks might actually be a conservative selection if the individual stock prices move differently. Either way, Markowitz said, diversification is the key. According to Markowitz, the appropriate action for an investor is to first identify the level of risk you are comfortable handling, and then construct an efficient, diversified portfolio of low covariance stocks. Markowitz's book, like the original paper 7 years earlier, was for all practical purposes soundly ignored by investment professionals. A mathematical definition of risk. Then, about 10 years after Markowitz's groundbreaking paper first appeared, a young PhD student named Bill Sharp approached Markowitz, who was then working on linear programming at the Rand Institute. Sharp was in need of a dissertation topic, and one of his professors at UCLA had suggested he track down Markowitz. Obliging the young Sharp, Markowitz told him of his work in portfolio theory and the need for estimating countless covariances. Sharp listened intently, then returned to UCLA. The next year, in 1963, Sharp's dissertation was published, A Simplified Model of Portfolio Analysis. While fully acknowledging his reliance on Markowitz's ideas, Sharp suggested a simpler method that would avoid the countless covariant calculations required by Markowitz. It was Sharp's contention that all securities bore a common relationship with some underlying base factor. This could be a stock market index, the gross national product, or some other price index, as long as it was the single most important influence on the behavior of the security. Using Sharp's theory, an analyst would need only to measure the relationship of the security to the dominant base factor. It greatly simplified Markowitz's approach. Let's look at common stocks. According to Sharp, the base factor for stock prices, the single greatest influence on their behavior, was the stock market itself. Also important but less influential were industry groups and unique characteristics about the stock itself. If the stock price is more volatile than the market as a whole, then the stock will make the portfolio more variable and therefore more risky. Conversely, if the stock price is less volatile than the market, then adding the stock will make the portfolio less variable and less volatile. Now, the volatility of the portfolio could be determined easily by the simple weighted average volatility of the individual securities. Sharp's volatility measure was given a name, beta factor. Beta is described as the degree of correlation between two separate price movements, the market as a whole and the individual stock. Stocks that rise and fall in value exactly in line with the market are assigned a beta of 1.0. If a stock rises and falls twice as fast as the market, its beta is 2.0. If a stock's move is only 80% of the market's move, the beta is 0.8. Based solely on this information, we can ascertain the weighted average beta of the portfolio. The conclusion is that any portfolio with a beta greater than 1.0 will be more risky than the market, and a portfolio beta less than 1.0 will be less risky. A year after publishing his dissertation on portfolio theory, Sharpe introduced a far-reaching concept called the Capital Asset Pricing Model, CAPM. It was a direct extension of his single-factor model for composing efficient portfolios. According to CAPM, stocks carry two distinct risks. One risk is simply the risk of being in the market, which Sharpe called systematic risk. Systematic risk is beta, and it cannot be diversified away. The second type, called unsystematic risk, is the risk specific to a company's economic position. Unlike systematic risk, unsystematic risk can be diversified away by simply adding different stocks to the portfolio. Peter Bernstein, the noted writer, researcher, and founding editor of the Journal of Portfolio Management, has spent considerable time with Sharpe and has studied his work in depth. Bernstein believes that Sharpe's research points out one inescapable conclusion. The efficient portfolio is the stock market itself. No other portfolio with equal risk can offer a higher expected return. No other portfolio with equal expected return will be less risky. In other words, the capital asset pricing model says that the stock market portfolio lies perfectly on Markowitz's efficient frontier. So, in the space of 1 decade, two academicians had defined two important elements of what we would later come to call modern portfolio theory. Markowitz, with his idea that the proper reward-risk balance depends on diversification, and Sharpe with his definition of risk. A third piece, the efficient market theory, came from a young assistant professor of finance at the University of Chicago, Eugene Fama. Efficient market theory. Although several other distinguished researchers have written on efficient markets, including the MIT economist Paul Samuelson, it is Fama who is most credited with developing a comprehensive theory of the behavior of the stock market. Fama began studying the changes in stock prices in the early 1960s. An intense reader, he absorbed all the written work on stock market behavior then available, but it appears he was especially influenced by the French mathematician Benoit Mandelbrot. Mandelbrot, who developed fractal geometry, argued that because stock prices fluctuated so irregularly, they would never oblige any fundamental or statistical research. Furthermore, the pattern of irregular price movements was bound to intensify, causing unexpectedly large, intense shifts. Fama's PhD dissertation, The Behavior of Stock Prices, was published in the Journal of Business in 1963 and later excerpted in the Financial Analyst's Journal and the Institutional Investor. Fama, a relatively young newcomer, had definitely caught the attention of the finance community. Fama's message was very clear. Stock prices are not predictable because the market is too efficient. In an efficient market, as information becomes available, a great many smart people, Fama called them rational profit maximizers, aggressively apply that information in a way that causes prices to adjust instantaneously before anyone can profit. Predictions about the future, therefore, have no place in an efficient market because the share prices adjust too quickly. Fama does admit that it is impossible to test empirically the idea of an efficient market. The alternative, he figured, was to identify trading systems or traders who could outperform the stock market. If such a group existed, the market was obviously not efficient. But if no one could demonstrate an ability to beat the market, then we could assume that prices reflect all available information and hence the market is efficient. The intertwined threads of modern portfolio theory were of consuming interest to the theorists and researchers who developed them. But throughout the 1950s and 1960s, Wall Street paid little attention. Peter Bernstein has suggested a reason, the simple fact that during this time portfolio management was uncharted territory. However, by 1974, this all changed. Without question, it was the 73-74 bear market that forced investment professionals to take seriously the writings coming from academia that promoted new methods to control risk. The self-inflicted financial wounds caused by decades of careless speculation were simply too deep. The market disaster of 1974 convinced me that there had to be a better way to manage investment portfolios, Bernstein said. Even if I could have convinced myself to turn my back on the theoretical structure that the academics were erecting, there was too much of it coming from major universities for me to accept the view of my colleagues that it was a lot of baloney. Thus, for the first time in history, our financial destiny rested not in the hands of Wall Street or Washington, D.C., not even in the hands of business owners. Rather, the financial landscape going forward would be defined by a group of university professors on whose doors the finance professionals had finally come knocking. From their ivory towers, they now became the new high priests of modern finance. Buffett and modern portfolio theory. Meanwhile, Warren Buffett, while concentrating his energies on the Berkshire Hathaway business, was also keeping a keen eye on the market. Whereas most investment professionals saw 1973 to 1974 as a period of debilitating losses, Buffett, the disciple of Ben Graham, saw only opportunity. And he knew when to act. Consider, for example, what happened with the Washington Post. We bought the Washington Post company at a valuation of $80 million back in 1974, Buffett later recalled. If you'd asked any one of 100 analysts how much the company was worth when we were buying it, no one would have argued about the fact it was worth $400 million. Now, under the whole theory of beta and modern portfolio theory, we would have been doing something riskier buying stock for $40 million than we were buying it for $80 million, even though it's worth $400 million, because it would have had more volatility. With that, they've lost me. The purchase of the Post was a clear signal that Buffett was embarking on a course that would put him at odds with most other investment professionals. He also made it clear what he thought of the three main ingredients of modern portfolio theory. Buffett on risk. Recall that in modern portfolio theory, risk is defined by the volatility of the share price. But throughout his career, Buffett has always perceived the drop in share prices as an opportunity to make additional money. If anything, a dip in price actually reduces the risk Buffett takes. He points out, for owners of a business, and that's the way we think of shareholders, the academic's definition of risk is far off the mark, so much so that it produces absurdities. Buffett has a different definition of risk, the possibility of harm or injury. And that is a factor of the intrinsic value risk of the business, not the price behavior of the stock. The real risk, Buffett says, is whether after-tax returns from an investment will give him, an investor, at least as much purchasing power as he had to begin with, plus a modest rate of interest on that initial stake. In Buffett's view, harm or injury comes from misjudging the four primary factors that determine the future profits of the business, plus the uncontrollable, unpredictable effect of taxes and inflation. Now here are those four factors. Is it a good investment? To ascertain the probability of achieving a return on your initial stake, Buffett encourages you to keep four primary factors clearly in mind. 1. The certainty with which the long-term economic characteristics of the business can be evaluated. 2. The certainty with which management can be evaluated, both as to its ability to realize the full potential of the business and to wisely employ its cash flows. 3. The certainty with which management can be counted on to channel the rewards from the business to the shareholders rather than to itself. And 4. The purchase price of the business. Furthermore, risk, for Buffett, is inextricably linked to an investor's time horizon. If you buy a stock today, he explains, with the intention of selling it tomorrow, then you have entered into a risky transaction. The odds of predicting whether share prices will be up or down in a short period are no greater than the odds of predicting the toss of a coin. You will lose half of the time. However, says Buffett, if you extend your time horizon out to several years, the probability of its being a risky transaction declines meaningfully, assuming, of course, that you have made a sensible purchase. If you ask me to assess the risk of buying Coca-Cola this morning and selling it tomorrow morning, Buffett says, I'd say that that's a very risky transaction. But to buy Coca-Cola this morning and to hold it for 10 years, the risk, in Buffett's way of thinking, is zero. Buffett on diversification. Buffett's view on risk drives his diversification strategy, and here too his thinking is the polar opposite of modern portfolio theory. According to that theory, remember, the primary benefit of a broadly diversified portfolio is to mitigate the price volatility of the individual stocks. But if you are unconcerned with price volatility, as Buffett is, then you will also see portfolio diversification in a different light. The strategy we've adopted precludes our following standard diversification dogma, says Buffett. Many pundits would therefore say the strategy must be riskier than that employed by more conventional investors. We believe that a policy of portfolio concentration may well decrease risk if it raises, as it should, both the intensity with which an investor thinks about a business and the comfort level he must feel with its economic characteristics before buying into it. That is, by purposely focusing on just a few select companies, you are better able to study them closely and understand their intrinsic value. The more knowledge you have about your company, the less risk you are likely taking. Diversification serves as protection against ignorance, explains Buffett. If you want to make sure that nothing bad happens to you relative to the market, you should own everything. There is nothing wrong with that. It's a perfectly sound approach for somebody who doesn't know how to analyze businesses. In many ways, modern portfolio theory protects investors who have limited knowledge and understanding on how to value a business. But that protection comes with a price. According to Buffett, modern portfolio theory tells you how to be average. But I think almost anybody can figure out how to do average in the 5th grade. Buffett on the efficient market theory. If the efficient market theory is correct, there is no possibility, except random chance, that any person or group could outperform the market, and certainly no chance that the same one person or group could consistently do so. Yet, Buffett's performance record for the past 25 years is prima facie evidence that it is possible, especially when combined with the experience of several other bright individuals who also have beaten the market following Buffett's lead. So what does that say about the efficient market theory? Proponents of the theory have never seemed interested in discordant evidence, Buffett observed. Apparently, a reluctance to recant and thereby to demystify the priesthood is not limited to theologians. The reasons why the efficient market theory is not defensible can be easily summarized. 1. Investors are not always rational. According to the efficient market theory, investors, by using all available information, set rational prices in the marketplace. However, there is extensive research in behavioral psychology which suggests that investors do not possess rational expectations. 2. Investors do not process information correctly. They continually rely on shortcuts to determine stock prices rather than the fundamental analysis that would reveal the intrinsic value of a company. 3. Performance yardsticks emphasize short-term performance, which makes it all but impossible to beat the market over the long term. Buffett's problem with the efficient market theory rests on one central point, that it makes no provision for investors who analyze all the available information and gain a competitive advantage by doing so. Observing correctly that the market was frequently efficient, they went on to conclude incorrectly that it was always efficient. The difference between these propositions is night and day. Nonetheless, efficient market theory, EMT, is still religiously taught in business schools, a fact that gives Warren Buffett no end of satisfaction. Naturally, the disservice done students and gullible investment professionals who have swallowed EMT has been an extraordinary service to us and other followers of Graham, Buffett wryly observed. In any sort of a contest, financial, mental, or physical, it's an enormous advantage to have opponents who have been taught it's useless to even try. From a selfish standpoint, we should probably endow chairs to ensure the perpetual teaching of EMT. Modern theories notwithstanding, there is an investment strategy that is capable of outperforming the market, and it is guiding us toward an entirely new theory of portfolio management. Developing a new portfolio theory. Today, investors are caught at an intellectual crossroad. To the left lies the pathway of modern portfolio theory. It is a track that assumes investors are rational. The market is efficient, that risk is defined by price volatility, and that the only way to reduce risk is diversify broadly. To the right lies the focus portfolio theory. It is a distinctly separate track grounded in a different set of beliefs. That investors are not always rational because they suffer from periodic episodes of fear and greed. That the market is not always efficient, and therefore investors willing to study and learn are given opportunities to beat the market. That risk is not price-based, but economic-based. That the optimal portfolio is a focus portfolio that stresses big bets on high-probability events, as opposed to equally weighted bets on a mixed bag of probabilities. Before people can successfully use the focus portfolio strategy taught by Buffett, they must remove from their thinking the constructs of modern portfolio theory. Ordinarily, it would be easy to reject a model that is largely considered ineffectual. After all, there is nothing prideful or rewarding about being average. But modern portfolio theory has developed a long history and deep culture. It is full of neat formulas and Nobel Prize winners. We should not expect the defenders of modern portfolio theory to be easily swayed. To acquiesce threatens both their intellectual and financial capital. Fortunately, we do not have to take on the task of dismantling modern portfolio theory. Unfolding events will take care of that. If we follow Buffett's advice, the success we earn will eventually work to overthrow the less than effective model. Although modern portfolio theory has its share of intellectual heavyweights, do not lose sight of the fact that the lineage of focus investing includes some of history's greatest investors, including John Maynard Keynes, Phil Fisher, Charlie Munger, Lou Simpson, Bill Ruane, and Warren Buffett. If you are ever thrown off balance by the rumblings of modern portfolio theorists, take heart in the same advice Ben Graham gave to his students. You are neither right nor wrong because the crowd disagrees with you. You are right because your data and reasoning are right. Chapter 3. The Super Investors of Buffettville. Investing is not a game where the guy with the 160 IQ beats the guy with the 130 IQ. Warren Buffett. In the midst of the high-flying years of the 1920s, a young Benjamin Graham, who was already beginning to make his mark on Wall Street, approached Columbia University, his alma mater, about teaching a night school class in security analysis. He had been thinking of writing a book on the subject and thought that teaching the class would help him organize his ideas. Columbia accepted his proposal and put the class on the schedule for the fall term of 1927. No one was more surprised than Graham at the response. So many people showed up that the school put guards at the door to make sure those who were pre-registered got their seats. One of those was a young assistant professor from Columbia School of Business named David L. Dodd. He got in. The second year, the demand was even greater, as many wanted to take the class over in hope of picking up new tips. The following year was 1929. Over the next months, Graham was fully occupied in coping with the effects of the crash, both for himself and his clients, and so work on the book was delayed. He had asked his former student, David Dodd, to help with the writing, but even so, it was not until 1934, the height of the Great Depression, that the groundbreaking book with the mild-mannered title Security Analysis first appeared. Graham later said the delay was providential, for it allowed him to include wisdom acquired at the cost of much suffering. Security Analysis is universally acclaimed a classic and still in print after 5 editions and 65 years. It is impossible to overstate its influence on the modern world of investing or the enormous contributions of Ben Graham to the profession. 50 years after its original publication, the Columbia Business School sponsored a seminar marking the anniversary of this seminal text by 2 of its illustrious faculty, and invited Warren Buffett, one of the school's best-known alumni, and the most famous modern-day proponent of Graham's value approach, to address the gathering. Most of those in the audience that day in 1984, university professors, researchers, and other academicians, along with many investment professionals, still held firmly to modern portfolio theory and the validity of the efficient market. Buffett, as we know, just as firmly disagreed. In his speech, which he titled The Super Investors of Graham and Doddsville, Buffett told some stories, made a few unflashy jokes, and quietly, firmly, demolished the platform on which rested the efficient market theory. It was classic Warren Buffett, pure and unadulterated. He began by recapping the central argument of modern portfolio theory, that the stock market is efficient. All stocks are priced correctly, and therefore anyone who beats the market year after year is simply lucky. Maybe so, he said, but I know some folks who have done it, and their success can't be explained away as simply random chance. Still, to give the must-be-luck argument its fair hearing, he asked the audience to imagine a national coin-flipping contest in which 225 million Americans bet $1 on their guess. After each flip, the losers dropped out and the winners kept the pot and advanced to the next round. After 10 events, Buffett explained, there would be 220,000 winners left, who, by letting their winnings ride, would have gained $1,024. After another 10 tosses, there would be 215 winners, each with $1 million. Now, Buffett continued, the business school professors analyzing this national contest would point out that the coin tossers demonstrated no exceptional skill. The event could just as easily be replicated, they would protest, with a group of 225 million coin-flipping orangutans. Slowly building his case, Buffett granted the statistical possibility that by sheer chance the orangutans might get the same results. But imagine, he asked his audience, if 40 of those 215 winning animals came from the same zoo. Wouldn't we want to ask the zookeeper what he feeds his now very rich orangutans? The point, Buffett said, is that whenever a high concentration of anything occurs in one specific area, something unusual is going on at that spot and bears investigation. And what if, here comes his clincher, the members of this one unique group are defined not by where they live, but by whom they learned from. And thus we come to what Buffett called the intellectual village of Graham and Doddsville. All the examples he presented that day of individuals who had managed to beat the market consistently over time did so not because of luck, but because they all followed principles learned from the same source, Ben Graham. Although each of these investors called their own flips differently, explained Buffett, they are linked by a common approach that seeks to take advantage of discrepancies between market price and intrinsic value. Needless to say, our Graham and Dodd investors do not discuss beta, the capital asset pricing model, or covariance of returns, said Buffett. These are not subjects of any interest to them. In fact, most of them would have trouble defining those terms. In an article based on his 1984 speech, Buffett included tables that presented the impressive performance results of the residents of Graham and Doddsville. 15 years later, I thought it might be interesting to take an updated look at a few people who exemplify the approach defined by Graham and who also share Buffett's belief in the value of a focused portfolio with a smaller number of stocks. I think of them as the super investors of Buffettville: Charlie Munger, Bill Ruane, Lou Simpson, and of course Buffett himself. From their performance records there is much we can learn. But before we start this investigation, let us begin with the first focus investor. John Maynard Keynes. Most people recognize John Maynard Keynes for his contributions to economic theory. In addition to being a great macroeconomic thinker, Keynes was also a legendary investor. Proof of his investment prowess can be found in the performance record of the Chest Fund at King's College in Cambridge. Prior to 1920, King's College investments were restricted to fixed income securities only. However, when Keynes was appointed the second bursar in late 1919, he convinced the trustees to begin a separate fund that would contain only common stocks, currency, and commodity futures. This separate account became the Chest Fund. From 1927, when he was named first bursar, until his death in 1945, Keynes had sole responsibility for this account. In 1934, the same year that Security Analysis was published, Keynes wrote a letter to a colleague in which he explained why he preferred to limit his investments to just a few companies. 4 years later, he prepared a full policy report for the Chest Fund, outlining his investment principles. 1. A careful selection of a few investments having regard to their cheapness in relation to their probable, actual, and potential intrinsic value over a period of years ahead and in relation to alternative investments at the time. 2. A steadfast holding of these fairly large units through thick and thin, perhaps for several years, until either they have fulfilled their promise or it is evident that they were purchased on a mistake. 3. A balanced investment position, i.e., a variety of risks in spite of individual holdings being large and, if possible, opposed risks. My reading of Keynes' investment policy suggests he was a focus investor. He purposely limited his stocks to a select few and relied on fundamental analysis to estimate the value of his picks relative to price. He liked to keep portfolio turnover at a very low rate. He recognized the importance of diversifying his risks. I believe to oppose risk, his strategy was to focus on high-quality, predictable businesses with a variety of economic positions. So how well did Keynes perform? During the 18-year period, the Chest Fund achieved an average annual return of 13.2%, compared to UK market return, which remained basically flat. Considering that the time period included both the Great Depression and World War II, we would have to say that Keynes's performance was extraordinary. Even so, the Chest Fund endured some painful periods. In 3 separate years, its value dropped significantly more than the overall UK market, in 1930, 1938, and in 1940. From the large swings in the fund's fortune, it is obvious that the fund must have been more volatile than the market. Indeed, if we measure the standard deviation of the Chest Fund, we find it was almost 2.5 times more volatile than the general market. Without a doubt, investors in the fund received a bumpy ride, but in the end, outscored the market by a significantly large margin. Lest you think Keynes, with his macroeconomic background, possessed market timing skills, take further note of his investment policy. We have not proved able to take much advantage of a general, systematic movement out of and into ordinary shares as a whole at different phases of the trade cycle. As a result of these experiences, I am clear that the idea of wholesale shifts is for various reasons impracticable and indeed undesirable. Most of those who attempt to sell too late and buy too late, and do both too often, incurring heavy expenses and developing too unsettled and speculative a state of mind, which, if it is widespread, has besides the grave social disadvantage of aggravating the scale of the fluctuations. Buffett Partnership Limited. When Warren Buffett returned to Omaha in 1956 after Ben Graham dissolved his investment company, he began the limited investment partnership that we met in Chapter 2. At its opening, the partnership had a total funding of $105,100, a combined contribution of $105,000 from the 7 limited partners, and $100 from Buffett. He set himself a tough goal: to beat the Dow Jones Industrial Average by 10 points each year. He achieved that and much more. For the 13 years of the partnership's existence, its average annual return was 22% higher than the Dow. In all that time, he never had a down year. By 1965, the partnership's assets were $26 million. The Buffett partnership operated between 1957 and 1969, and its returns were both remarkable and somewhat abnormal. Remarkable in that Buffett creamed the Dow's average annual return by 22 percentage points over the period, and abnormal in that he was able to achieve the return with less volatility. His standard deviation, which is another way to express volatility, was lower than the Dow's. In his typical self-effacing way, Buffett quietly remarked, "I think that any way you figure it, it has been satisfactory." How did he do it? How did he manage to avoid the volatility that is usually associated with focused portfolios? Two possible explanations come to mind. First, he could have owned securities in the portfolio whose prices moved in a dissimilar fashion. Although I am sure he did not purposely construct a low covariance portfolio, a portfolio that was carefully designed to be economically diverse would likely smooth the bumps in the road. Another possible explanation, which is far more likely, is that Buffett's careful and disciplined approach to purchasing only securities that demonstrated a significant discount to their intrinsic value worked to limit his downside price risk while giving the partnership all the upside benefits. Charles Munger Partnership. Warren Buffett is often called the world's greatest investor, and that title is richly deserved. However, the outstanding record that Berkshire Hathaway has earned over the years comes not only from Buffett, but from the wise counsel of its vice chairman, Charles Munger. The one regret I have about the Warren Buffett way was underserving the importance Charlie has made in Buffett's thinking and Berkshire's fortune. Although Berkshire's investment performance is assigned to its chairman, we should never forget that Charlie is an outstanding investor himself. Shareholders who have attended Berkshire's annual meeting or read Charlie's thoughts in Outstanding Investor Digest realize what a fine intellect he has. "I ran into him in about 1960, said Buffett, "and I told him law was fine as a hobby, but he could do better." Charlie was a Harvard law graduate and at the time had a thriving practice in Los Angeles. However, Buffett convinced Charlie to take up investing. His portfolio was concentrated in very few securities, and therefore his record was much more volatile, explained Buffett. But it was based on the same discount from value approach. Charlie followed the Graham methodology and would only look at companies that were selling below their intrinsic value. He was willing to accept greater peaks and valleys in performance, and he happens to be a fella whose psyche goes toward concentration. Note that Buffett does not use the word risk in describing Charlie's performance. Using the conventional definition of risk, price volatility, we would have to say that Charlie's partnership was extremely risky, with a standard deviation almost twice that of the market. But beating the average annual return of the market by 18 points was not the act of a risky man, but rather an astute investor who was able to focus on a few outstanding stocks that were selling well below their calculated value. Sequoia Fund. Buffett first met Bill Ruane in 1951 when both were taking Ben Graham's security analysis class at Columbia. The two classmates stayed in contact, and Buffett watched Ruane's investment performance over the years with admiration. When Buffett closed his investment partnership in 1969, he got in touch with Ruane. "I asked Bill if he would set a fund to handle all of our partners, so we set up the Sequoia Fund." Both men knew it was a difficult time to set up a mutual fund, but Ruane plunged ahead. The stock market was splitting into a two-tier market. Most of the hot money was gyrating toward the nifty 50, the big-name companies like IBM and Xerox, leaving the value stocks far behind. Although, as Buffett pointed out, comparative performance for value investors was difficult in the beginning, I am happy to say that my partners, to an amazing degree, not only stayed with him, but added money with happy results. Sequoia Fund was a true pioneer. The first mutual fund run on the principles of focus investing. We have the public record of Sequoia's holdings, and it demonstrates clearly that Bill Ruane and his partner, Rick Cunniff, managed a tightly focused low-turnover portfolio. On average, Sequoia owned between 6 and 10 companies, which represented well over 90% of the portfolio. Even so, the economic diversity of the portfolio was and continues to be broad. Ruane has often pointed out that even though Sequoia is a focused portfolio, it has owned a variety of businesses, including commercial banking, pharmaceutical, and automobile and property casualty insurance. Bill Ruane's point of view is in many ways unique among mutual fund managers. Generally speaking, most investment management begins with some preconceived notion about portfolio management and then fills in the portfolio with various stocks. At Ruane, Cunniff & Company, they begin with the idea of selecting the best possible stocks and then let the portfolio form around these selections. Selecting the best possible stocks, of course, requires a high level of research. And here again, Ruane, Cunniff & Company stand apart from the rest of the industry. The firm has built a reputation as one of the brightest shops in money management. They eschew Wall Street's broker-fed research reports and instead rely on their own intensive company investigations. "We don't go in much for titles at our firm," Ruane once said, "but if we did, my business card would read Bill Ruane, Research Analyst." Such thinking is unusual on Wall Street, he explains. Typically, people start out their careers in an analyst function but aspire to get promoted to the more prestigious portfolio manager designation, which is considered to be a distinct and higher function. To the contrary, we have always believed that if you are a long-term investor, the analyst function is paramount, and the portfolio management follows naturally. How well has this unique approach served their shareholders? During the period 1971 through 1997, Sequoia earned an average annual return of 19.6% compared to the 14.5% of the Standard & Poor's 500 index. Like other focused portfolios, Sequoia achieved this above-average return with a slightly bumpier ride. The standard deviation of the market during this period, which you remember is one way to express volatility, was 16.4% compared to Sequoia's 20.6%. Some might call that a higher risk. But knowing the care and diligence Ruane, Cunniff & Company takes in selecting stocks, the conventional definition of risk does not apply here. Lou Simpson. At the beginning of 1996, Berkshire Hathaway completed the purchase of Geico, Inc., which at the time was the 7th largest automobile insurer in the country. It was the culmination of a long and profitable relationship. For those who have followed Warren Buffett over the years, Geico is a familiar name. The company holds a revered place in Berkshire Hathaway. Buffett originally was introduced to Geico in 1951 by his teacher, Ben Graham, who was then a director of the company. In true Buffett fashion, he traveled to Geico's headquarters one cold Saturday morning in January to learn more about the business. Lorimer Davidson, who at the time was assistant to the president, he later became CEO, gave Buffett a quick education about Geico's competitive advantage. When he returned to Omaha to work at his father's brokerage firm, Buffett focused his efforts on buying shares of Geico for his clients. He even wrote a research report about Geico in the Commercial and Financial Chronicle titled "The Security I Like Best." By year-end 1951, young Buffett had 65% of his net worth, $10,000, invested in Geico. In the early 1970s, Geico ran into problems. Several years of underpricing its policies had produced losses that almost bankrupted the company. Buffett, however, applying his own tenets, was undeterred. He was confident he was looking at a solid company temporarily experiencing difficulties that made its stock price a bargain, and began acquiring shares. By 1980, through Berkshire Hathaway, he had accumulated 33% of the company for $45.7 million. About that same time, Buffett made another acquisition that would have a direct benefit on the financial health of Geico. His name was Lou Simpson. Simpson, who earned a master's degree in economics from Princeton, worked for both Steinrow and Farnham and Western Asset Management before Buffett lured him to Geico in 1979. He is now CEO. Recalling his job interview, Buffett remembers that Lou had the ideal temperament for investing. According to Buffett, Lou was an independent thinker who was confident of his own research and who derived no particular pleasure from operating with or against the crowd. Lou is a voracious reader who ignores Wall Street research and instead pores over annual reports. His common stock selection process is similar to Buffett's. He only purchases high-return businesses run by able management that are available at reasonable prices. Lou also has something else in common with Buffett. He focuses his portfolio on only a few stocks. Geico's billion-dollar equity portfolio customarily owns less than 10 stocks. Between 1980 and 1995, the equity returns in Geico's portfolio achieved an average annual return of 24.7%, compared to the market's return of 17.8%. These are not only terrific figures, says Buffett, but, fully as important, they have been achieved in the right way. Lou has consistently invested in undervalued common stocks that individually were unlikely to present him with a permanent loss and that collectively were close to risk-free. Once again, in Buffett's mind, the estimate of risk has nothing to do with volatility, but rather with the certainty that the individual stocks will, over time, produce a profit. Simpson's performance and investment style fit neatly inside Buffett's way of thinking. Lou takes the same conservative, concentrated approach to investments that we do at Berkshire, and it is an enormous plus for us to have him on board, says Buffett. Buffett's admiration for Simpson is great. There are very few people who I will let run money in businesses that we have control over, but we are delighted in the case of Lou. His presence on the scene assures us that Berkshire would have an extraordinary professional immediately available to handle its investments if something were to happen to Charlie and me. Buffett, Munger, Ruane, Simpson. It is clear that the super investors of Buffettville have a common intellectual approach to investing. They are united in their belief that the way to reduce risk is to buy stocks only when the margin of safety, that is, the favorable discrepancy between the intrinsic value of the company and today's market price, is high. They also believe that concentrating their portfolio around a limited number of these high-probability events not only reduces risk, but helps to generate returns far above the market rate of return. Still, when we point out these successful focus investors, many people remain skeptical. Perhaps the success is based upon their close professional relationship. But as it turns out, all these stock pickers picked different stocks. Buffett didn't own what Munger owned, and Munger didn't own what Ruane owned. Ruane didn't own what Simpson owned, and nobody owned what Keynes owned. Well, that may be true, say the skeptics, but you've only shown me 5 examples of focus investors. 5 observations are not enough to draw a statistically meaningful conclusion. In an industry that has thousands of portfolio managers, 5 successes could simply be random chance. Fair enough. To eliminate any notion that the 5 super investors of Buffettville are nothing more than statistical aberrations, we need to examine a wider field. Unfortunately, we do not have a large number of focus investors to study. Without more cases, how do we proceed? By going inside a statistical laboratory and designing a universe of 12,000 portfolios. 3,000 focus investors. Using the CompuStat database of common stock returns, we isolated 1,200 companies that displayed measurable data, including revenues, earnings, and return on equity, from 1979 through 1986. We then asked the computer to randomly assemble from these 1,200 companies 12,000 portfolios of various sizes. 3,000 portfolios containing 250 stocks. 3,000 portfolios containing 100 stocks. 3,000 portfolios containing 50 stocks. 3,000 portfolios containing 15 stocks. Next, we calculated the average annual rate of return of each portfolio in each group over 2 different time periods, 10 years and 18 years, and plotted the distribution of these returns. Then we compared the returns of the 4 portfolio groups to the overall stock market, defined as the Standard & Poor's 500 index, for the same time periods. From all this, one key finding emerged. In every case, when we reduce the number of stocks in a portfolio, we begin to increase the probability of generating returns that are higher than the market's rate of return. Let's look a little deeper, starting with the 10-year time frame. All four portfolio groups had an average yearly return of about 13.8%. The Standard & Poor's average for the same period was somewhat higher, 15.2%. One important point to keep in mind is that the Standard & Poor's 500 is a weighted index dominated by the largest companies, and that the time period under consideration is one where large capitalization stocks did particularly well. In our study, the portfolios are equally weighted and include not only large capitalization stocks but small and mid-sized companies as well. So, we can say that the four groups of laboratory portfolios performed on an approximate par with the general market. Where this starts to get interesting, though, is when we look at the minimum-maximum numbers, that is, the worst-performing and the best-performing portfolios in each group. Here's what we find. Among the 250 stock portfolios, the best return was 16.0%, and the worst was 11.4%. Among the 100 stock portfolios, the best return was 18.3%, and the worst was 10.0%. Among the 50 stock portfolios, the best return was 19.1%, and the worst was 8.6%. Among the 15 stock portfolios, the best return was 26.6%, and the worst was 4.4%. These are the focus portfolios in the study, and the only group whose best returns are substantially higher than the Standard & Poor's. The same relative trends hold in the longer 18-year periods, with the small portfolios showing much higher highs and lower lows than the large portfolios. This leads us to two inescapable conclusions. One, you have a much higher chance of doing better than the market with a focus portfolio. Two, you also have a much higher chance of doing worse than the market with a focus portfolio. To reinforce conclusion number one for the skeptics, we found some remarkable statistics when we sorted the 10-year data. Out of 3,015 stock portfolios, 808 beat the market. Out of 3,050 stock portfolios, 549 beat the market. Out of 3,100 stock portfolios, 337 beat the market. And out of 3,250 stock portfolios, only 63 beat the market. I submit this is convincing evidence that the probabilities go up as the size of the portfolio goes down. With a 15-stock portfolio, you have a 1 in 4 chance of outperforming the market. With a 250-stock portfolio, 1 in 50. Another important consideration. In our study, we did not factor in the effect of trading expenses. Obviously, where the turnover rate is higher, so are the costs. If these realized expenses were included in our graphs, the annualized returns would shift to the left, making it even harder to beat a market rate of return. As to conclusion number two, it simply reinforces the critical importance of intelligent stock selection. It is no coincidence that the super investors of Buffettville are also superior stock pickers. If you have not picked the right companies, your underperformance will be striking. However, we can suggest that the outsized returns earned by the super investors are made possible by their willingness to focus their portfolios on their best ideas, a point that becomes crystal clear when we analyze the common stock portfolio of Berkshire Hathaway. Berkshire Hathaway. Over the last 33 years, between 1965 and 1997, the per-share book value of Berkshire Hathaway has grown at an average annual rate of 24.9%, almost twice the Standard & Poor's 500 index. At this rate, the per-share book value of Berkshire has doubled every 2.9 years, compounding an above-average rate for 30 years. Now you know why there are so many Berkshire Hathaway millionaires. Book value is a good measuring stick for judging the company's progress over time, but it muddies our analysis of portfolio management. Berkshire's book value includes not only its common stock holdings, but also its fixed income investments and its closely held businesses. Lumped into Berkshire's book value performance record is the book value of See's Candy Shops, Nebraska Furniture Mart, Buffalo News, Flight Safety, and Scott Fetzer. What would we find if we stripped away all of the non-common stock investments and analyzed Berkshire's equity portfolio separately? The results are eye-popping. For this analysis, we isolated Berkshire's equity portfolio reported in the annual report each year from 1988 through 1997. We limited the study to the company's listed primary holdings and ignored the unidentified group referred to as other common stock holdings. Because we cannot identify these holdings and because they represent such a small percent of the equity portfolio, deleting their returns from the study does not meaningfully change the results. One other small caveat. Berkshire reports common stock holdings as of year end. But for our purposes, we assume that Berkshire owned these securities identically on January 1. Of course, Buffett made purchases throughout the year, so to assume each and every position was a full annual return is not correct. However, many of the positions were fully held throughout the year, and considering we are analyzing a 10-year period, I believe any discrepancy is not meaningful. I was first interested to know the return of Berkshire's primary common portfolio over the last 10 years. The average annual return of this group was 29.4%, far superior to the Standard & Poor's 500 index, which earned 18.9%. Most people who have followed Warren Buffett's career know he is high on the Coca-Cola Company. Clearly, the big bets Buffett made on Coca-Cola over the years paid off handsomely. In 1988, when Buffett began buying the stock, Coca-Cola represented 20.7% of the common stock portion of Berkshire's portfolio. From 1991 through 1997, Coca-Cola's position in the portfolio ranged from 34.2% to 43%. And how well did Coca-Cola perform during those 10 years? Almost double the regular market. 34.7% average return compared to 18.8%. In this case, it was highly profitable for Buffett to concentrate his position around Coca-Cola. A big bet on a high probability event. Now, what would have happened if Buffett did not overweight his positions but simply maintained an equal balance in his stocks each and every year? To do so, he would sell off a few shares when a position got too big to bring it back in line with the others. On an equally weighted basis, Berkshire's portfolio would have returned 27.0%, just over 2.5 percentage points less than the concentrated portfolio. Let's take our analysis one last step. Let us assume that Buffett did not run a concentrated portfolio, but a more broadly diversified portfolio of 50 names. Let us further assume that each of Berkshire's primary holdings represented a 2% weighting, suggesting a 50-stock portfolio, and that the balance of the portfolio generated a market rate of return. Although the balance of this fictitious portfolio would include a group of stocks that on average could do no better than the market, they could also do no worse. This fictitious portfolio, made up of Berkshire's actual stocks plus market return stocks, all 2% equally weighted, would have generated a 20.1% average annual return over the period, only 1.2% better than the market. Looking back, we can plainly see that the concentrated focus portfolio delivered the best results. Equally weighting the portfolio still beat the market, but narrowed the performance spread by just over 3 percentage points. Finally, the fictitious 50-stock portfolio, although slightly outperforming the market on average basis, had the weakest results, dropping down 9 percentage points. This exercise is meant to illustrate, as did our earlier study on the 15, 50, 100, and 250 stock portfolios, that focus portfolios that concentrate on high probability events give the optimal returns. Conversely, attempts to dilute the portfolio with more names in mindlessly equal installments will likely drive returns closer to a market rate of return. Once you adjust these returns by subtracting the commissions and expenses, you begin to appreciate how difficult it is to outperform the market with hundreds of stocks that are constantly being bought and sold. The Flat Earth Society. In his 1984 speech at Columbia, Warren Buffett made the wry observation that if everyone agreed with him and moved over to the focus style of investing, he would be destroying some of his own advantage because the spread between value and price would shrink. But, he quickly added, experience has shown that's not likely to happen. The secret has been out for 50 years, ever since Ben Graham and Dave Dodd wrote Security Analysis, yet I have seen no trend toward value investing in the 35 years I practiced it, Buffett said. There seems to be some perverse human characteristic that likes to make easy things difficult. He may be right. 15 years later, there has been no rush toward focus investing. You will recall that in order to have enough observations to make a statistically defensible argument, we had to artificially create portfolios in a computer lab. Perhaps, as Buffett says, we have even backed away from the teaching of value investing. It's likely to continue that way. Ships will sail around the world, but the Flat Earth Society will flourish. There will continue to be wide discrepancies between price and value in the marketplace, and those who read their Graham and Dodd will continue to prosper. It is, as has been observed in other contexts, pretty darned hard to argue with success. Chapter 4. A Better Way to Measure Performance. When the price of a stock can be influenced by a herd on Wall Street, with prices set at the margin by the most emotional person, or the greediest person, or the most depressed person, it is hard to argue that the market always prices rationally. In fact, market prices are frequently nonsensical. Warren Buffett. If Buffett is right, if market prices are frequently nonsensical, then we are foolish indeed to use price as a sole indicator of performance. Yet we do. Our entire industry is price myopic. If the price of a particular stock is going up, we assume good things are happening. If the price starts to go down, we assume something bad is happening and act accordingly. But if prices are not always completely rational, are we being completely rational when we base our actions on their ups and downs? This conundrum is vastly exacerbated by another foolish habit, evaluating price performance over very short periods of time. Not only are we depending on the wrong thing, price, Buffett would say we're looking at it too often and we're too quick to jump when we don't like what we see. This double-barreled foolishness, this price-based, short-term mentality is a flawed way of thinking, and it shows up at every level in our business. It is what prompts some people to check stock quotes every day and call their broker so often they have the phone number on speed dial. It is why institutional investors with responsibility for billions of dollars are ready to buy or sell at the snap of a finger. It is the reason managers of mutual funds churn the stocks in the fund's portfolio at dizzying rates. They think it is their job to do so. Amazingly, those same money managers are the first to urge their clients to remain calm when things start to look shaky, sending out reassuring letters lauding the virtue of staying the course. So why don't they practice what they preach? It is especially easy to observe this contradiction in the case of mutual funds, because their actions are so thoroughly documented and scrutinized by the financial press. Because so much information is available, and because mutual funds are so familiar and well understood, I believe we can learn a great deal about the folly of a price-based measure by looking at how it works in mutual funds. The double standard in mutual funds. Writing in Fortune magazine late in 1997, Joseph Nocera pointed out the obvious inconsistencies between what mutual fund managers recommend shareholders do, namely buy and hold, with what managers actually do with their own portfolio, namely buy-sell, buy-sell, buy-sell. Reinforcing his own observations of this double standard, Nocera quoted Morningstar's Don Phillips. There is a huge disconnect between what the fund industry does and what it tells investors to do. The obvious question becomes, if investors are counseled to wisely buy and hold, why do managers frenetically buy and sell stocks each year? The answer, says Nocera, is that the internal dynamics of the fund industry make it almost impossible for fund managers to look beyond short term. Why? Because the business of mutual funds has turned into a senseless, short-term game of who has best performance, measured totally by price. Today, there is substantial pressure on portfolio managers to generate eye-catching short-term performance numbers. These numbers attract a lot of attention. Every 3 months, leading publications, such as the Wall Street Journal and Barron's, publish quarterly performance rankings of mutual funds. The funds that have done best in the past 3 months move to the top of the list, are praised by financial commentators on television and in newspapers, rush to put out self-congratulatory advertising and promotion, and attract a flurry of new deposits. Investors, who have been waiting to see which fund manager has the hot hand, pounce on these ratings. Indeed, quarterly performance rankings are increasingly used to separate the gifted managers from the mediocre. This fixation on short-term price performance, while acutely obvious in mutual funds, is not limited to them. It dominates thinking throughout our industry. We are no longer in an environment where managers are measured over the long term. Even people who function as their own manager, as many of you may do, are infected by the unhealthy nuances of this environment. In many ways, we have become enslaved to a marketing machine which all but guarantees underperformance. Caught in a vicious circle, there appears to be no way out. But of course, as we have learned, there is a way to improve investment performance. The cruel irony is that the strategy most likely to provide above-average returns over time appears incompatible with how we judge performance, either a mutual fund manager's or our own. The Tortoise and the Hare. In 1986, V. Eugene Sheehan, the Columbia University Business School alumnus and portfolio manager at U.S. Trust, wrote a follow-up article to Buffett's The Super Investors of Graham and Doddsville. In his piece titled, Are Short-Term Performance and Value Investing Mutually Exclusive?, Sheehan took on the same question that we are now asking, namely, how appropriate is it to measure a money manager's skill on the basis of short-term performance? He notes that, with the exception of Buffett himself, many of the people Buffett described as super investors, undeniably skilled, undeniably successful, faced periods of short-term underperformance. In a money management version of The Tortoise and the Hare, Sheehan comments, it may be another of life's ironies that investors principally concerned with short-term performance may very well achieve it, but at the expense of long-term results. The outstanding records of the super investors of Graham and Doddsville were compiled with apparent indifference to short-term performance. In today's mutual fund performance derby, he points out, many of the super investors of Graham and Doddsville would have been overlooked. The same is also true of the super investors of Buffettville, those 5 focus investors we met in Chapter 3. They definitely struggled through several difficult periods. Only Buffett, again, went through the performance derby unscathed. John Maynard Keynes, who managed the Chest Fund for 18 years, underperformed the market 1/3 of the time. Indeed, he underperformed the market the first 3 years he managed the fund, putting himself behind the market by 18 percentage points. The story is similar at Sequoia Fund. Over the marking period, Sequoia underperformed 37% of the time. Like Keynes, Ruane also had difficulty coming of age. Over the years, we have periodically qualified to be the kings of underperformance. We had the blurred vision to start the Sequoia Fund in mid-1970 and suffered the Chinese water torture of underperforming the Standard & Poor's 4 straight years. By the end of 1974, Sequoia was a whopping 36 percentage points behind the market. We hid under the desk, didn't answer the phones, and wondered if the storm would ever clear. But of course the storm did clear. By the end of 1976, Sequoia Fund was 50% ahead of the market over the 5.5-year period. And by 1978, Sequoia had gained 220% versus 60% for the Standard & Poor's 500 index. Even Charlie Munger couldn't escape the inevitable bumps of focus investing. Over 14 years, Charlie underperformed 36% of the time. Like other focus investors, he also had a string of bad luck. From 1972 through 1974, Munger fell behind the market by 37 percentage points. Over 17 years, Lou Simpson underperformed 4 years, or 24% of the time. His worst relative performance occurred in a 1-year period and found him 15 percentage points behind the market. Incidentally, we see the same trends when we analyze the behavior of our laboratory-focused portfolios. Of the 3,000 portfolios holding 15 stocks, 808 beat the market during the 10-year period, 1987 to 1996. Yet of those 808 winners, an astonishing 95% endured some prolonged period of underperformance, 3, 4, 5, even 6 years out of 10. What do you think would happen to Keynes, Munger, Simpson, or Ruane if they were rookie managers starting their careers today in an environment that can only see the value of 1 year's performance. They would probably have been canned, to their clients' profound loss. Yet, following the argument that the focus strategy does sometimes mean enduring several weak years, we run into a very real problem. How can we tell, using just price performance as our measure, whether we are looking at a very bright manager who is having a poor year, or even a poor 3 years, but will do well over the long haul, or one who is starting a long string of bad years? We can't. Not that we haven't tried. Academics and researchers have invested considerable energy trying to determine which money managers, which strategies have the best chance of beating the market over time. In the past few years, the prestigious Journal of Finance has published several articles based on studies by prominent university professors, all asking the same basic question: is there a pattern to mutual fund performance? Together, these professors all bring considerable intellectual weight and data analysis to the problem, but their findings fail to produce a perfect answer. Of these studies, 4 dealt with what academics term persistence, the tendency of investors to choose funds with the best recent records because they believe a fund manager's track record is an indication of future performance. This creates a kind of self-fulfilling momentum in which this year's money follows the top fund from the last few years. When this momentum is measured in 1-year units, picking next year's winner by buying last year's winner, we describe this as the hot hands phenomenon. It is all a matter of trying to predict which funds will do well in the near future by observing what they did in the near past. Can it be done? That was what these studies attempted to find out. In 2 separate studies, Mark Carhart of USC's School of Business Administration and Burton Malkiel of Princeton were unable to find any meaningful correlation between persistence and future performance. In the 3rd study, 3 professors from the John F. Kennedy School of Government at Harvard, Darrell Hendricks, Jayendu Patel, and Richard Zeckhauser, looked at 15 years of data and concluded there appears to be no guarantee that buying this year's hot hand manager would assure owning next year's hot hand fund. Finally, Stephen Brown of the Leonard Stern School of Business at New York University and William Getzman from Yale's School of Management concluded that persistence is largely a matter of commonalities in strategy. In other words, among any group of hot hands, we would probably find several managers all following the same strategy. What these academics have learned is there appears to be no significant evidence available that will help investors locate next year's top performers. Certainly bouncing from one hot fund to the next does nothing to aid investors in building their net worth, not when hot is defined by price performance. We can well imagine what Warren Buffett might make of these academic studies. For him, the moral of the story is clear. We have to drop our insistence on price as the only measuring stick, and we have to break ourselves of the counterproductive habit of making short-term judgments. But if price is not the best measuring stick, what are we to use instead? Nothing is not a good answer. Even buy-and-hold strategists don't recommend keeping your eyes shut. We just have to find another benchmark for measuring performance. Fortunately, there is one, and it is the cornerstone to how Buffett judges his performance and the performance of his operating units at Berkshire Hathaway. Alternative performance benchmarks. Warren Buffett once said he wouldn't care if the stock market closed for a year or two. After all, it closes every Saturday and Sunday, and that hasn't bothered me yet. Now, it is true that an active trading market is useful, since it periodically presents us with mouth-watering opportunities, said Buffett. But by no means is it essential. To fully appreciate this statement, you need to think carefully about what Buffett said next. A prolonged suspension of trading in securities we hold would not bother us any more than does the lack of daily quotations for World Book or Feckheimer, 2 Berkshire Hathaway subsidiaries. Eventually, our economic fate will be determined by the economic fate of the business we own, whether our ownership is partial, in the form of shares of stock, or total. If you owned a business and there was no daily quote to measure its performance, how would you determine your progress? Likely, you would measure the growth in earnings, or perhaps the improvement in operating margins, or a reduction in capital expenditures. You simply would let the economics of the business dictate whether you are increasing or decreasing the value of your business. In Buffett's mind, the litmus test for measuring the performance of a private company is no different than measuring the performance of a publicly traded company. Charlie and I let our marketable equities tell us by their operating results, not by their daily or even yearly price quotations, whether our investments are successful, explains Buffett. The market may ignore business success for a while, but it eventually will confirm it. But can we count on the market to reward us for picking the right economic companies? Can we draw a significantly strong correlation between the operating earnings of a company and its future share price? The answer appears to be yes, if we are given the appropriate time horizon. Using our group of 1,200 companies, we can readily appreciate the relationship between earnings and share price exhibited over different time periods. However, when we set out to determine how closely price and earnings are connected, we learned that the longer the time period, the stronger the correlation. With stocks held for 3 years, the degree of correlation ranged from 0.131 to 0.360. A correlation of 0.360 means that 36% of the variance in price was explained by the variance in earnings. With stocks held for 5 years, the correlation ranged from 0.374 to 0.599. In a 10-year holding period, the correlation increased to a range of 0.593 to 0.695. For the entire 18-year period, the correlation between earnings and share price is 0.688, a significantly meaningful relationship. This bears out Buffett's thesis that a strong business will eventually command a strong price, given enough time. He cautions, though, that the translation of earnings into share price is both uneven and unpredictable. Although the relationship between earnings and price strengthens over time, it is not always prescient. While market values track business values quite well over long periods, Buffett notes, in any given year the relationship can gyrate capriciously. 65 years ago, Ben Graham gave us the same lesson. In the short run, the market is a voting machine, but in the long run, it is a weighing machine. It is clear that Buffett is in no hurry to have the market affirm what he already believes is true. The speed at which a business's success is recognized, furthermore, is not that important as long as the company's intrinsic value is increasing at a satisfactory rate, he says. In fact, delayed recognition can be an advantage. It may give us the chance to buy more of a good thing at a bargain price. Look-through earnings. To help shareholders appreciate the value of Berkshire Hathaway's large common stock investments, Buffett coined the term look-through earnings. Berkshire's look-through earnings are made up of the operating earnings of its consolidated businesses, its subsidiaries, the retained earnings of its large common stock investments, and an allowance for the tax that Berkshire would have had to pay if the retained earnings were actually paid out. Retained earnings are the portion of a company's annual earnings that are not distributed to shareholders in the form of dividends, but are reinvested back into the company. Over the years, Berkshire's share of retained earnings from its large common stock holdings, including Coca-Cola, Federal Home Loan Mortgage, Gillette, the Washington Post Company, and others, has been significant. In 1997, the figure was $743 million. Now, under generally accepted accounting rules, GAAP, Berkshire can't report its share of retained earnings in its income statement, even though, as Buffett